now going to shift tack a little bit, and we're going to now sort of look at another big theme, and a more sort of a step towards cleaner fuels, if you will. But we'll examine the near and distant futures of liquefied natural gas in the LNG market, a very capital intensive and complex market which is evolving very rapidly. And for that, I have two very, very knowledgeable guests. Pat, could you introduce yourself?
Yes, hi everybody. I'm Pat Roberts. I'm Managing Director of LNG-Worldwide Limited, which is a commercial LNG consulting firm.
And Christophe, could you introduce yourself?
So my name is Christophe Malet. I am the Senior Vice President for Upstream LNG at a privately held Chinese energy company. And I'm also involved in various LNG business and project development in Asia and Africa.
Thank you. So without any further ado, we're going to now dive into the evolution issues, structural challenges, and modeling issues within the LNG universe. So Pat, how can LNG serve as a transition fuel? What are the key financial issues do you think that is sort of in the market itself, and what do you think the emerging global market for LNG is doing to the volatility and the dynamics of that market, if you will? To start with, Pat?
Yes, so the LNG market has always been very capital intensive. That doesn't change now or looking forward into the future. But what LNG, I think, actually needs is long-term partnerships. So these are partnerships where you will have project sponsors that will want to commit a lot of capital to projects, providing that they can still sign 15 to 20-year offtakes. And the market is actually looking quite positive and constructive, that there are players out there who really both want to develop LNG projects, confident, of the resources there to produce LNG long term, but also growingly of security of supply from buyers, and also portfolio aggregators who are saying we really do see LNG as a viable transition fuel. So you're seeing deals being signed, for 20 years forward, or even up to 27 years forward at the moment. So there is the capital there, always the capital for a good project. And what you're seeing is a massive two-pillar growth between Qatar and the United States, principally. Very different models, but very viable models for the future.
Christophe, your perspective?
Yeah, I think what I'd like to add to Pat's comments is that, on the question of how LNG serves the transition, I think we have to talk about energy transitions with an S or plural form, because it is now established that different regions will see most likely different transitions. And so LNG could possibly have a different role, whether you look at Asia or Europe or the rest of the world. So that's the first point. Now, as Pat rightly said, this industry is very capital intensive, and the development of new LNG capacity has always been underpinned by long-term contracts with credit-worthy off-takers. And as a result, in fact, all the projects are competing somehow for the same blue chip buyers. And I think we've come to a point where we're kind of we're stretching the boundaries of this model, where basically those investment grade buyers actually are known. They are finite. There is a finite number of those buyers, and other regional strong players, which can be considered as second tier, third tier in certain regions, are serious buyers, but may not show the same basically balance sheet. However, those buyers are buying oil products such as LPG, diesel, and so on. And so that's one of the challenges of the industry is to continue not only to finance the development of new LNG industry assets, but potentially move in terms of business model towards towards something which is more looking like the oil or oil products markets. But that is a challenge, and we have not yet seen definitive signs of that. Although we have seen new players coming into the mix, which may change, with a different culture, the one thing. And I'd like to finish on the volatility, because clearly last few years we've seen very high volatility in this market for various reasons. But the volatility somehow is only a reflection of the changes that happen in the market and the related uncertainties. And we can say that for sure that we have had a lot of foreseen, but a lot of unforeseen changes that have had considerable impact on this industry, to the extent that we are talking about long-lasting changes or even structural changes now in the energy market structure.
Now, I think you mentioned a couple of things, and Pat alluded to it as well. But what do you think is the impact of this concentration? Is that part of the reason for the volatility, or do you think most of the volatility is actually more intrinsic? I mean, it is coming out of geopolitics, it's coming out of structural changes in the technology and the operational business and business environments, if you will.
I mean, without a doubt, it's linked to very short-term supply demand. And we've seen massive disruptors. We saw the massive disruptor from COVID-19 cratering demand very quickly, so there was an oversupply. And then we've seen, with the Russian invasion of Ukraine and a disengagement of Russian gas in Europe, a massive demand surge for LNG in Europe. And the business model, it finds it very hard to sort of deal with plus or minus 50 million tons of demand that can happen very quickly. But as the business grows, obviously it becomes more liquid, it becomes more responsive. So as Christophe rightly said, we see a lot of volatility that has happened. We're not expecting structural volatility to be eliminated going forward, but there are more degrees of freedom of being able to manage it as the business grows, and as the business models evolve as well. And I think that we see a lot of latent demand coming from energy transitions, where countries set a basic target and then companies have to implement these targets. But there's a lot of uncertainty at the sort of speed at which they will be able to implement them. So LNG has to be, if you like, the flexible backup fuel. And it has to be contracted in a flexible way as well. The upshot of it all, if I look in the crystal ball, is probably big players get bigger and the strong players get stronger, and there probably is some concentration in the market. But having said all of that, our market is growing by about 200 million tons in the next 6 years, and it's only a 400 million ton market at the moment. So there's a huge amount of growth to come through, and that will bring with it, I'm sure, quite a lot of changes in the way in which LNG is traded.
No, so I wanted to pick up on that in the way the LNG is traded, if you will. What kind of changes do you, first of all, anticipate in the way it would be traded in the future? And again, is there any ways you think that that this change might reduce volatility? Does that need the introduction of banks, or do the large super majors can handle and provide risk management tools to smaller institutions? Where do you see perhaps the market moving, and what mechanisms do you think might evolve to reduce the risk for smaller players?
Christophe, do you want to take that, or do you want me to?
Yeah, I'm happy to go at this one. Clearly, I would start from the basics. LNG is quite complicated to model and to analyze because of the nature of this industry. It's not standardized, it's not commoditized, and there are still very wide variations in what is being traded in the market. So that's one of the reasons why, if we talk about tools and related, and various products that have been developed in the past. That's why we have not seen, for example, the emergence of a single, trading platform, which used to, which got developed, 5 to 8 years ago, about 8 years ago. I mean, eventually, you find out that traders, they still need to talk one-on-one with counterparts. The information they get from various subscriptions and the price reporting agencies is not considered as sufficient to know what is going on. And so there is also a bit of an asymmetry of information in that market, because I think there is a premium or an edge to the bigger organizations. So at the end of the day, where is this going? I mean, of course, you see, I think on the trading side, more sophistication being added, but there is still a bit of, customization, I would say, at various level, which makes it very difficult to be entirely standardized. And that's only for trading, but don't forget that you have people out there working on developing long-term contracts, other developing assets. And so that's a wide range of various needs which needs to be catered.
And if I could,
that's my
could I just add to Christophe's points as well? I think you were sort of looking at LNG as a demand-driven business, and as Christophe sort of said earlier, that community of buyers is changing quite a lot. You've got the sort of top-tier, sort of credit-worthy buyers, probably with very sophisticated procurement sort of divisions and trading divisions. But a lot of the new demand brings in new players as well, smaller volumes and very price sensitive, and probably needing quite a lot of flexibility operationally. And I'm a genuine believer that the industry is evolving around all of these challenges, and the global portfolio players are actually playing a very big role. And these are the majors like Shell, Total, BP, ExxonMobil, etc., who say we will warehouse the big volume risk that's required from long-term contracts, and we will buy into our portfolio these big positions, and then we'll disaggregate them to sort of sell to bespoke customers, who want an offering where they wouldn't be able to get that directly from the producer. So there's a very big role in that. And within these big aggregators is, of course, the need for a lot of cargo tracking, a lot of cargo data, cargo and pricing analytics. And we haven't yet even mentioned the idea of a lot of data that's going to be required for carbon footprint evaluations of the LNG. But that's certainly coming to the market in the next few years, I would say, where cargoes of LNG will have to have a sort of carbon emissions certificate, and that will be used as a marketing tool. So there's a lot to play for in this, but the industry is set up quite well, I think, to be able to manage the transition.
And I mean, I think...
Sid, there's a couple of points I'd like to add to that, because yes, indeed, the big portfolio players and large global commodity traders, they are stepping in the market, and today they are providing liquidity. They take on long-term exposure, underpinning new liquefaction capacity, and then they kind of supply those second, third-tier buyers, which may not be able to do so. But I think there is another obvious, basically, driver here, which is going to be the Chinese market, with Chinese players now benefiting from the growth in the Chinese market, the somehow early stage, but still deregulation of the Chinese market, and supporting the building of portfolios. And what you see is that the large Chinese buyers are, I think, set to become portfolio players as well. And one question is about whether or when China is going to be able to provide maybe a gas index that will be as deep, as strong, as robust as a TTF or some of the European gas index. And I think that will be when we get there, that will be a significant change in the market.
No, of course, that would be, I mean, clearly the size and scale of the Chinese market gives potential for significant portfolio players to emerge and potentially be balancers in the business, as Pat was talking about the current super majors. I just wanted to ask both of you a related question: is do you think as the super majors and the emerging super majors from China sort of provide flexibility and balancing for their smaller counterparts, clearly there is going to be a creditworthiness issue coming in as they provide that. They're going to be taking more and more credit risk as they sort of provide these services or this balancing for their counterparts, if you will. Do you think they're ready? Do you think the credit modeling in this industry, counterparty modeling, counterparty analytics, and the data that supports all of that is ready for in this industry? Or do you think there are some ways to go and some things that need to change?
There's definitely some ways to go. I think that the Russian invasion of Ukraine in 2022 highlighted that LNG cargoes for a single cargo, could go up in value to about $250 million. Now that's a real extreme and it was unprecedented, but the whole credit worthiness of trading and your counterparties and risk was brought into sharp focus then. And it's, I think, woken up a lot of people that the sort of steady as she goes approach has got to be adapted for all of these sort of very strange, sort of unusual events. It has meant that some traders have stopped trading LNG. Some have just said, this is not a business I want to be in, and the same too for risk management with sort of margin calls. But out of these sort of crises, if you look back in sort of history at all the sort of various oil products we've all traded in the past, you do get a new market development. And I think that for those who are staying in with LNG, they will have very highly sophisticated risk management teams. And that will probably become a new feature of buyers as well, that they will need risk management sort of structures as well to work alongside this.
What I would add to your comment, Pat, is that in fact, this criteria of creditworthiness is likely to determine in which part or which pocket of the market those players are able to play. On a short term or next few months. Variations on price can be better assessed, and the credit requirement is not the same as for a 20-year contract. So clearly, based on their financial capacity and ability to provide credit, players will have to play on one pocket of the market, or maybe more, and the smallers will remain on the short-term market.
Yeah,
I think that is a very interesting point, that you think credit will actually segment and segregate and structure various elements of the market structure and market itself. So I have actually one final question for both of you, if you will. Looking forward and looking at your crystal ball, do you see any external structures coming into the LNG market which potentially can mitigate some of these risks, such as bilateral collateralization or futures or any other form of mutualization that could reduce some of the credit risks and hence allow more risk capital to come into the market? First, Christophe, then.
I think that there is the one market, which is, for me, the emergence of LNG as a fuel, which is likely to change the game here, because we talk about LNG to power, LNG to traditional gas markets. But for LNG as a fuel, we're not going to see the same credit requirements. Those fuel markets, they work on a short-term basis, and they have a significant potential to increase over the next few years. So I see on this segment the game to change, and those, let's say, the credit worthiness barrier to entry being much lower at the end of the day.
Pat?
Yeah, no, I won't. I'll try and think of something additive to say to this. I think that what we're going to see a lot of actually in the future, and we started to see these trends in the last year or two, is that buyers going back to Brent indexation or crude oil indexation for gas, rather than sort of going headlong into sort of buying long-term off spot market hubs, partly because Brent was something they found they were more comfortable with, their downstream markets perhaps were more linked to them, and also they could hedge that more. But I think that there's going to be a lot more risk management from the buyer side, as well as from the intermediate players. And I think that risk management services are going to sort of be in demand as well, more so than they have been in the last few years. So I would say that people who thought oil indexation was coming to an end, I don't see that happening. I see it still growing and quite prevalent in Asia. And that's, after all, where we see most of the bulk in demand growth for the future.
Well, that's all we have time for today, Pat and Christophe. Thank you both very much. But clearly, if you look at it, clearly from what you've seen, it's a complex market. The crystal balls, both their crystal balls suggest a lot of evolution, significant growth, and perhaps significant transformation with structural impacts from credit and other areas as well. So thank you, Pat. Thank you, Christophe. And we could have gone on for much longer, but we're out of time. Thank you.
Yeah, you're welcome. Thank you.